Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Case for a chat. And while I'm bringing this up, I might end up talking something completely different because the nature of our guest is such today. However, the case for a chat that I'm making today for Samit Vartak, the quality over value amidst life highs, or does value triumph over quality, or is there a mix there? Non-banks better placed amongst BFSI, or can banks make a bit of a comeback? And global headwinds persist for metals, or can that change as well? And all of this is happening, Samit Vartak, because since March, I haven't read a memo from you. Otherwise, it just becomes very, very simple to know how to structure the conversation. Good morning, and thanks so much for joining in on Talking Point today, Samit. Hope all is well.
All well, Neeraj. Always a pleasure to be here.
Thank you so much. I miss your writing, Samit, so it's cue that you write one more memo soon. But
yes, within the next fortnight, hopefully.
Within the next fortnight, hopefully. Okay, good. I'll look forward to reading that and maybe talking about it a bit later as well. But Samit, without giving out too many takeaways from your memo, just trying to understand how do you think about this? Because at various points of time in the past, when people have spoken about excessive valuations, you've pointed out the dichotomy in looking at market-wide valuations versus what's happening at the broader end of the spectrum, specific buckets, etc., and how value was there. And that's proven right thus far. So I'm trying to understand, amidst the most common narrative of markets across the board being expensive, what are your thoughts on the numbers based on history or otherwise?
Sure. Yeah, I think, the most popular metrics used for valuations are P multiple or EV/EBITDA. Those kind of metrics are more P&L based. I think the game-changing event for India, which happened post-COVID, was the improvement in balance sheet. The balance sheet has improved. The previous decade, we saw median debt to equity of 0.6, 0.64. Today it's at 0.14. That's a huge drop, and that's the improvement. Plus, if you see, the P&L profits are supported by operating cash flow. It's not, so they're still above 100%. And the return on equity, return on capital metrics are near all-time highs, right? So that's a big difference. Now, the ratio that I look at is basically incorporates P&L as well as balance sheet, which is, enterprise value to operating cash flow. Now, enterprise value to operating cash flow basically, has ranged, up to 25, 26 times during 2018-19, as well as in 2008. Today we are below 20 times. So it's about 19 and a half, right? So which is not suggesting, and this is for the top 1,000 companies, this is the weighted average, right? So of course, there are pockets which are more expensive. And especially once you go towards the smaller caps, or you go towards anything to do with capital goods, anything to do with government incentives, those kind of pockets are expensive, but overall broader markets are not that expensive. And this is excluding financials. Financials, as you know, the banking stocks are cheaper. I'm saying beyond just financials, because you can't look at the enterprise value to operating cash flow for financials. So I'm excluding that. And even that universe is the median over the last 20 years is about 17.1 times. We are at 19.4. And hence, some overvaluation probably the market deserves, given the fundamentals of the balance sheet, the fundamentals of the banking system, the kind of capex the government is putting. And more importantly is even the private capex. I think we keep on focusing on the corporates for private capex, but there is so much capex going into real estate, right? The real estate today, real estate generally one of the biggest drivers of the economy, and it percolates into a lot of different ancillary industries. Today, real estate inventory is the lowest. If you look at the top 8 cities, there's an Axis report. It shows that since 2010, we have the lowest inventory today. So there could be a lot of projects which have been launched, but we are still sitting at the lowest inventory, and probably we have a few more years real estate boom, that kind of capex which comes, and government itself, is putting up significant capex. Their rate of spending has gone up. So government capex, strong balance sheet, strong cash flow, private capex in terms of real estate, as well as the general corporate private capex, in terms of building factories or putting up new capacity, even that's picking up. So these are pretty positive things, and you got to look at the overall valuation in this context.
Got it. Okay. So, Samit, have you, given a choice, if you had a choice to sit on cash, etc., would you do that, or would you veer the portfolio maybe towards more safety if you are maybe not as constructive? I mean, what are you doing right now? And given a choice, if you had a choice of taking cash, would you sit on cash right now?
See, Neeraj, I think I've learned through multiple cycles, since 1999, is that taking a macro call on cash is extremely risky. It's very, very expensive sometimes if you get out at the wrong time, because it's not just taking a cash call one way, right? You also need to get it right getting in. A lot of people did take a cash call during COVID time, but then the pullback was so sharp, within a couple of months, things were back to normal, at least in terms of the stock prices. And very few people could get back. So getting it right one way is not good enough. And then getting it right both ways in multiple cycles is almost impossible, right? I mean, I have presented this statistic previously, but I think it's always worth repeating. And I have, sort of updated the analysis. If you look at Sensex has gone up 670 times, 670 times since 1979, right? And if you rank all the days, there were about 10,500 days during these many years. And if you rank from the top performing day to the bottom, and if you look at the best performing 112 days, those are the ones who have contributed towards the entire 670 times. That means if you miss out on 112 is roughly about 1% of the 10,500 days. If you missed out on the 1% best days, your returns would have been zero. Of course, the opposite of that is also true, is that if you had missed out on the best one or worst 1% days, then your returns would have been 4.6 lakh times. So both are true, but I think one has to look at the market as it's not a zero-sum game, right? The long-term historical returns have been in that 14 to 15% range. That means the return line is uptrending. So when the return line is uptrending, it's always more expensive to miss out on the best days rather than missing out on the worst days. So given that statistics, mathematically it doesn't make sense to sit out unless you can exactly time the market. So from that perspective, I never take a top-down call, but bottoms-up is very important. Is that, in such times when everything looks frothy, you need to be even more choosy, and you need to pick pockets where you're very confident about the earnings growth. Earnings growth, I feel, is the confidence in earnings growth, or the resilience of earnings growth, is the biggest measure of quality of a business. So, I don't believe in just looking at the management quality or sort of the modes of the business. If there is no earnings growth and if there is no resilience of earnings growth, what's the use of that kind of a quality? So you got to be very confident about the earnings growth, and against that, what is a comfortable valuation you are able to pay. Even if you pay a little higher valuation, it's okay. If the earnings come through, you may have some time correction, but in the long run, you will generally make those returns. I mean, everyone knows that in the short run, valuation multiples may be the bigger driver of returns, but in the long run, it's the earnings growth. And if you're able to pick companies with high earnings growth, or whatever hurdle rate that you have, and you pay reasonable valuation, they may not be cheap, in the long run, your returns will match the earnings growth. So there is no reason to move away from that discipline and from that process. These are not extraordinary kind of conditions where you think that the markets or the economy is at the peak, the banking system is over leveraged, the corporates are over leveraged. companies are finding it difficult to collect cash, and at that point the markets are trading at all-time high. That those kind of environment is risky. But today, I think we are at the start of a capex cycle on the private side. Government has just started huge capex over the last 2 or 3 years. We had that missing since 2012. And I think if we are see in an investor's life, maybe you'll get two big bull markets. Maybe it's once in every 20 years, right? So if you miss out on one, it can be one of the most expensive decisions. So it's not worth sort of taking that kind of a macro call.
By the way, Sensex is at new highs yet again. But Samit, are we in the midst of one such bull market? What's your hypothesis?
I mean, given the condition of the balance sheet, given the prudency of corporate India, given where the banking system is, and given the real estate cycle, given that the capex was missing for last, since 2012 to 2022, it's possible that whatever missed out, probably we, compensate for that beyond the average, over the next 10 years. Right. So if our historical growth rate has been about 13-14%, last 2012 to 2022 was in single digit, we may make up for that. So instead of 13-14%, we could grow at 16-17%, not the 32% that we grew in 2003 to 2008. Because at that time there were multiple cylinders which were really firing: the global market, the government capex, private capex, real estate, infrastructure. A lot of those things were picking. China was, in starting into a big capex cycle. We are missing the global factor, but the domestic factors are way better today than what they were. We are going in a measured way, in a much more efficient way. So we may not have that kind of a cycle, but it could be a long, prolonged cycle where there could be short-term corrections in between. But we have to ride this cycle. It looks like an India decade. Not just from a story perspective, but just look at the numbers. And it is highly possible. It's very difficult to predict such cycles. But when the fundamentals are so strong, valuation cannot be the only reason why you get out of the market. You need to pick your pockets right, because there are 1,000 stocks even for a fund manager to pick. And if you are looking for 15-20 stocks to build a portfolio, you generally need to find those. If you are not able to find those, then okay, you can sit in cash, but it has to be bottoms up reason. And if you're not able to find opportunities, whatever you find is extremely risky, then okay, you sit on cash until you find something which is comfortable to you. But I think if you do enough hard work, you are finding enough opportunities, and there are multiple sectors which is offering that.
Okay, so we are in the midst of a bull market, and some hypotheses around potential returns that could come in as well. It's a hypothesis, viewers. You need to build your own if you are an investor yourself, so bear that in mind. Samit, just before we get to pockets which are giving you the opportunity, I want to understand about pockets which were the crowd favorites until about 3 months ago, and since then the pullback has happened. And some of the naysayers would say that we told you so, that trees don't grow to the sky, valuation excesses get corrected, and stocks don't bounce back. So viewers, here's a chart. This is the defense aggregate market cap in lakh crores, of course. And if you look at it, it peaked in July. Since then, it's about a 21-22% downtick in defense, and similarly for railways as well. Big jump in the last 3 years, peaked in July. Railways will also come up on your screen. And then there's a dip that came in. So both for defense and railways, the dip has been fairly swift, and it's not showing signs of turning around. Samit, what happens in these? Because the sound bites of order book, growth, all stayed true even now. Stocks have come off. That is not to say they will stay here. My question therefore is, will a showcasing of earnings growth revive the fortunes of some of these? Because it does look very likely that the earnings growth in some of these pockets will look very strong in the quarters to come.
Right. Yeah. I mean, in the last interview, I think, I'd sent out a table where the railways and defense were the top performing, and then you look at their earnings growth, it was completely missing, and then the stocks had just multiplied and just didn't make sense. See, I think again, what I define by quality, as I said, is earning growth as well as resilience and predictability of that earnings growth, right? And defense, whether it's railways, these are the life cycle of these products, whether it's the railway wagons or some defense equipment, sometimes is very long. It can be 30, 40 years, right? So that the longer the life cycle of the product that you cater to, the more volatile it becomes because it depends completely on the capex. So railways can have great 2, 3 years, but who knows? In case the government changes or in case the government policy changes, and suddenly the order book stops, right? You can have a really one bad year, and during that one bad year, market has no idea, and then it crashes. And hence, if you look at these kind of stocks, whether it's defense stocks or railway stocks, thrice in the last 15 years, it has corrected by 80 to 90%. Just because of the uncertainty, it can have great run, but then 1 or 2 bad years where there is no visibility going forward can correct these stocks. So such stocks cannot be valued like a resilient, high quality business. One has to know that it's a highly cyclical. These are highly cyclical stocks, and accordingly, you need to value them because the risk associated has to be compensated by the cheapness of the valuation. Whereas a lot of these stocks have are trading at almost FMCG kind of valuation, so it doesn't make sense. So I think it's again bottoms up. You need to understand those businesses, the risks associated with those businesses, and how resilient is the earnings growth as well as the earnings quality. And if you find such businesses, see, in investment, it's always important that you reject most of the businesses and only bet on businesses where you're confident about that earnings growth, earnings quality, and bet on those. Paying high valuation is a much less riskier decision than betting on low valuation and extremely low quality business in terms of earnings growth and earnings resilience.
Okay, fair point. Now, Samit, tell us, where is it that you're finding a mix of quality of business or quality of earnings and resilience in the current context? And are some of these pockets available at good valuations, or the valuations are stretched?
Right. See, again, it's a bottoms up. Some of the pockets which are offering reasonable opportunities, I think, are niche NBFCs, where the return on equity is high, where the assets are extremely secured. There are, CDMO spaces, there are specialty chemical spaces which are more related to maybe electric vehicles. There are a lot of building materials which haven't gone anywhere in the last 1.5 years, right? And they are exposed to the biggest capex, whether it's real estate or a factory buildup or government capex. So they will definitely benefit it. Some of them are going through maybe some down cycle of the Chinese pressure on metals. And during those times, some of these companies do go through inventory losses, and hence investors don't want to touch them during such times. But those are the times when you have an opportunity to get these long-term good businesses at reasonable valuations. So I think those are such opportunities which are available in these kind of sectors. And sometimes a sector may not be that great, but you'll find one-off opportunity in those even expensive sectors, which is something that you like, or which is trading at comfortable value. So again, bottoms up is a very different story. Top down can give you some direction, but still your stock picking has to be bottoms up.
Okay, stock picking has to be bottoms up. You mentioned some pockets, Samit, very difficult to figure out what would be the right valuation to pay. So for example, let's talk about real estate. You have some investments there.
Yeah.
You bought into them earlier. That sector has run for a bit, right? Would you pay top dollar currently to real estate? Do you believe the cycle will last? And is a better way to bet on real estate through pure play real estate companies or through ancillaries?
So ancillaries are, if you find them with good valuations, also are great place. Either you can bet them through housing finance, you can bet it through the materials which are used in real estate. But see, real estate is a very it's even more bottoms up because it completely depends on that real estate company. The location is very important, where their projects are. And real estate is very difficult to value in terms of a lot of metrics. The metric that I use is that whatever is the market cap of that company, look at the operating profit that the company will make over the next 6 to 7 years. If that operating profit is higher than the market cap, today's market cap, I find it reasonably valued or cheap. So I mean, if you want reasonable value, you can stretch it up to maybe 10 years. But whatever projects the company has you know, under their development, and over the next 6 to 7 years, if the operating profit make up for the market cap, it's generally a great investment. It's worked out, for me multiple times, and that's the metric that I use. Now again, it's again very company specific. I can't talk about the overall sector, but the overall sector itself is, and as I said, it's at lowest inventory levels in the top 8 cities, and urban real estate makes up for 2/3 of the value of India, right? So it's a big contributor towards real estate, and real estate does contribute almost 1/3 of the capex, of India. So it is a big contributor. So depending on your understanding of the businesses, your comfort, you can bet it through multiple ways.
Okay. You spoke about housing finance. There is this big housing finance listing that's happened, trading at a substantial premium, market cap equal to or more than the 10 next housing finance companies. Is this a sign of excess in that space, or do you believe that after a hiatus that space might start working again? Because NBFCs or banks per se haven't quite gone anywhere, if you will.
Yeah, I mean, it's such a market today that anything new gets more much attention and attraction, and maybe it's in the it's for the short run. So the older similar businesses are boring, and no one is interested because it comes in with their historical performance baggages. But I think this is a time when you need to identify which are those businesses which have delivered in the past in terms of protecting its assets, in terms of delivering 20%, close to 20% kind of return on equity, are well managed. Management in finance is extremely important. It's one of the biggest factor, and that's where Bajaj Finance, Bajaj Housing gets those kind of valuation only because of the management, and then the belief and confidence in their management that they will be able to ride through the cycles, protecting capital, right? So, but there are many companies which are available at probably 1/3, 1/4 the valuation with similar kind of or better metrics. And there are a lot of options in that space, and again, haven't done too much over the last, compared to what a lot of these pockets have done. Haven't done too much, and I think there are a lot of opportunities in this space. This also building materials. Building materials, you can bet it through PVC pipes, structural pipes. You can bet it through MDF. I mean, there are so many ways where don't need to bet on the entire sector, but if you find a player, which sometimes is really attractive, those with the industry tailwind, I think they will deliver over the next 3, 4, 5 years. And rather than focusing on sectors which are sort of in the story and where there is a lot of talk, I think always good to look at sectors where no one is talking about, which seem very boring. Maybe the stocks haven't done anything in the last 1, 2 years, and hence no one is interested in them. Unfortunately, the better the stock does, the more interest it generates.
That's true.
And stocks which haven't done anything, they are completely abandoned, and that's the opportunity.
Yeah, that's true. Samit, one final word. I mean, a sector that is a bit complex to understand, but while you say that, maybe look at sectors which are, I mean, maybe it might be a good idea at sometimes to look at sectors which are not in vogue. CDMO is in vogue, especially because of the Biosecure Act, and
Yeah.
suddenly people talking about how fortunes will change. It's not an immediate thing any which ways, but because it's such a difficult one to track, because each company might be doing things different, and there is this whole US FDA piece around them, etc. How constructive are you? Are you taking a large bet on CDMO, and are you spreading bets, or have you chosen it? I mean, are you playing it via maybe just one company or two companies because you know the companies very well?
Yeah, again, I am completely playing it through just one company in each portfolio. So not really betting on the see because biosecure it's a very niche segment, and not all the CDMO players will benefit, from the US ban on China. And in CDMO, it's also important that whether you have the capacity already built up, no US company is going to come to you if you don't have the capacity. And sometimes it takes years to build up that kind of a capacity. And China is a big, supplier. And to replace that, we'll need a huge capacity to be built up. It may take time, but right now, because of sort of the macro story, people get excited about all the CDMO players, which have no relationship with the ban. And so again, it's completely bottoms up is very important. You need to know exactly the earnings growth potential. They should be delivering at this point. It should not be just based on hope that they will benefit from this China plus one kind of a story. It's always better to understand that right now they have triggers, right now they have the capacity, and they're already delivering. Better to pay a little higher valuation, but have high confidence in that earnings growth, and again the resilience of that earnings growth.
Point well noted. Samit, great talking to you today. Thanks so much for taking the time out and being with us. Looking forward to talking to you once more in or around the festive season.
Thank you so much, Neeraj, for inviting me, and always a pleasure.
So Samit Vartak writing a memo in the next fortnight or so. We'll talk about that and get him around Diwali as well. But with that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.